It's the nightmare scenario for many Canadian homeowners, a real estate market bubble leading to a crash. If it were to happen, prices could have a long way to fall. This index shows the big run-up in national home prices since 1999. At the same time, Canadians have been taking advantage of low interest rates, racking up debt to finance their homeownership dreams. Hillard MacBeth is Director of Wealth Management at Richardson GMP and author of the upcoming book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. We talked earlier and I asked him to describe the warning signs of a real estate bubble.
Well, the definition of a bubble, as some people have laid it out, are a period of rapidly rising prices. People feel regret for having missed out on the bubble. The media get involved in calling it a bubble. One of the things that drew me to this was clients who've been with me for 30 years. In the last 10 years, started to obsess about real estate. And not every client and not everyone to the same degree, but I really noticed, and I started to ask why. Why would they be doing that? And so all of those things together, and the more that I researched it and the more I asked questions about it, the more convinced I became that we are in a significant bubble in Canada. The other way to look at it is to compare it to other countries like the United States or Portugal or Ireland. And we come up as one of the most expensive real estate markets in the world today.
So when you say a significant bubble, what might that mean? One thing that people wonder is, of course, if there is some kind of a change in prices, softening in prices, is it a correction, is it a soft landing, or is it a real hard landing, a hard decline? What's your view?
Well, there's a couple of things about soft landing, of course. So we've had leaders recently say that we're either not in a bubble, or if we're in a bubble, it's going to be a soft landing. Really, what is a soft landing? A soft landing is a period when prices level off or maybe decline slightly. And then, of course, what happens after that? Well, if it turns out to be a soft landing, it would have to be that prices would then resume their upward trend. And that isn't what happens in a bubble. So if we are in a bubble, as I'm convinced we are, then we can't get out with a soft landing. We have to have a hard landing. And a hard landing means that we have to go back to the trend line that was in place before the bubble started to appear.
And if we revert to that mean, if we go back to that trend line, how bad could that be?
40 to 50% drop in prices in Canada.
And if we see a 40 to 50% drop in the value of our real estate, what would that do to our economy?
Well, that's a good question. We saw what happened in the U.S. and the declines in the U.S. were similar to that. Every country is different, and it depends on the degree of concentration of the component that makes up the residential real estate investment segment. So in the U.S., it peaked out at around 6% of GDP. Currently at Canada, we're at 7% of GDP. They went all the way down to 2% of GDP in the U.S., and they've recovered to 3%. So we would be looking at something similar, maybe going down to 3% of GDP, and that would be a 4% drop. So that's a pretty significant, that's a recession for sure, some kind of recession.
We saw a real estate-led recession in the early 1990s. Would it be like that, do you think? Or because that wasn't a 40% decline, it was more like 20%, could it be much worse?
Well, it could be worse than that. And the difference this time, of course, there was quite a bit of inflation in the early 90s. And there was an earlier bubble in the early 80s as well. And what allowed us to get out of that with a less than 40 or 50% decline was the fact that inflation was running fairly hot, 5 and 10% a year. So if prices are just flat for a couple of years, people don't notice it, but actually they've lost 20% if inflation is 10% a year. This time around, unfortunately, our inflation is only 1%. So therefore, we have to actually see actual declines in prices. And that's going to be the difficult part about this adjustment. So it probably would be a little worse than the early 90s, depending on how long it takes. The U.S. correction in housing, which is probably not over yet, that housing market peaked in 2006, and we're not too far away from 2015. So it's 9 years and counting in the U.S. So if it's spread out over a decade, that's probably the most likely outcome.
So when do you think such a correction would take place, or I suppose what would precipitate it in your view?
Well, there's a bunch of different things that could cause it and trigger it. And although people that have studied bubbles in the past indicate that there isn't always a trigger. Like one of the most famous bubbles was the tulip bulb mania in Holland in the early 1600s. And it was so incredibly outrageous that people have studied it over and over again, and they couldn't find a single trigger or reason why people just woke up one morning and sort of came out of the trance and thought, gee, what am I doing paying these incredible prices? And in Canada, you know, it would be possibly with housing is a little different because there's so much debt involved. It might be that first-time buyer and the investment buyer who wake up sometimes simultaneously. Somehow they all wake up the same day and say, you know what, I really don't want to take on a $400,000 mortgage. You know, it just seems crazy to me to do that.
So given that you have these clients who have been thinking about real estate in this way that I think you find unnerving or alarming, what is the right way to think about the value of your home? Should we think of it as an investment that will appreciate over time? Should we think of it simply as a store of value? What do you tell clients?
Well, I tell them not to think of it as investment. Think of it as a lifestyle choice. But there is a component of housing that is of value, and that is you avoid the rental payments that you would make if you were a renter. So there's definitely that value. But what's crept in now is an extra component, which I call the speculative component. And I would say forget about the speculative component. Now, the speculative component could be positive or negative. So it's at best going to be neutral, but probably going to be negative. So people should look at the housing as where they live, as an alternative to paying rent, but certainly not expect any investment component. And that's a bit of a problem for baby boomers like myself, because a lot of us have a fairly large amount of equity in our homes. Yeah. And some people, not me, but some people are thinking that that's going to help them with retirement living, but it's unlikely that that's going to be the case. So the trigger, though, getting back to your question, would be that first-time buyer that can't, you know, the new money that comes into the market is really the first-time buyer and the investment buyer, and both of them are at the margin.
All right. We got to leave it there, Hillard. We appreciate your time today.
Thank you.
Hillard MacBeth, Director of Wealth Management at Richardson GMP.